Welcome to a special deep dive. We're focusing entirely on corporate performance today, really digging into the market signals from the latest earnings cycle.
That's right. We are Talk Tickers, and today we're tearing apart the Q3 2025 earnings call from a major player in the global tire game.
This call dropped pre-market November 4th, and yeah, it definitely made some waves.
It certainly did. You know, the immediate market take suggested management really managed to reframe the story.
How so?
Well, the overall tone coming off that call, even with all the global turbulence, it felt, I'd say, constructively bullish.
Oh, okay, constructively bullish, signaling what? More clarity.
Exactly, signaling execution clarity. Investors seem to feel they're really getting a handle on things, controlling what they can control, despite the wider volatility.
Makes sense. So our mission today, folks, is pretty simple. Give you the signal, cut through the noise.
Right. We're distilling the core financials, looking hard at the aggressive strategic moves.
And breaking down that critical forward guidance, the stuff that actually matters for understanding where this tire giant is headed, really through the end of 2026.
Okay, let's kick off with those headline numbers, the ones that really sparked that initial positive vibe.
Go for it.
Management delivered a pretty decisive non-GAAP adjusted earnings per share beat. Came in at $0.28.
And the street was expecting?
Much lower. The consensus range was only hovering around $0.14 to $0.16, so quite a significant beat there.
Wow, okay. And revenue?
Revenue landed pretty much right on target, $4.6 billion, roughly in line.
Okay, so if revenue was just in line, the beat wasn't about selling like tons more tires. It must have come from somewhere else.
Precisely. It points towards execution, towards margin, cost discipline. That's the story.
And how do we see that discipline in the numbers? What's the key metric?
The key figure demonstrating that is segment operating income, or SOI, as we call it.
Yeah.
Landed at $287 million.
Which translates to what kind of margin?
That worked out to a 6.2% margin. Now, that number was down year over year.
Yeah.
Got to be clear about that.
But
the critical data point, the one that really seemed to convince traders things were moving in the right direction, was the sequential jump.
Quarter over quarter.
Yes. A staggering $128 million increase in SOI compared just to the second quarter. That kind of sequential acceleration, it suggests those internal changes, the transformation plan, it's finally starting to kick in.
Okay, so that's the positive spin, the non-GAAP beat driven by operations. But we can't ignore that big gap number, can we? There was a massive net loss reported.
No, you absolutely have to address it. That's a crucial question. How do you square a solid earnings beat with, like you said, a historically massive GAAP net loss?
So how do we reconcile that?
Well, the company did report the GAAP net loss of $2.2 billion. Huge number. But you need to understand, almost all of that loss was driven by two really big non-cash, non-recurring items.
Non-cash, non-recurring. Okay, like...
Think of it as management cleaning house, basically.
Okay.
They took a significant deferred tax asset valuation allowance that was $1.4 billion right there.
Yeah.
And then a large goodwill impairment, mainly in the Americas segment, totaling about $674 million.
So these are like accounting adjustments, balance sheet moves?
Essentially, yes. They're adjusting asset values down to reflect the current reality. Big non-operational hits. And that's precisely why the market, quite rightly, focused on the non-GAAP adjusted EPS. That's the figure reflecting their actual operating performance during the quarter.
Got it. So the adjusted number shows how the business ran. The GAAP number shows the big balance sheet cleanup.
You got it.
And thinking about preventing future cleanups like that goodwill write-down, that really brings us to the whole transformation story. It sounds like the biggest theme was reshaping the portfolio and, crucially, getting debt down, deleveraging.
It was absolutely front and center on the call. They confirmed they've completed their major planned divestitures.
Which ones specifically?
That includes selling off the road or OTR business, those giant tires for mining and industrial gear.
Right.
The sale of the Dunlop brand rights in certain markets.
Right.
And the sale of their chemicals business. In fact, the chemicals sale closed just before the call, so it gives them a really clean path forward now.
And these aren't small deals. We're talking significant cash coming in.
Yeah. These transactions collectively generated around $2.2 billion in total proceeds. Big number.
And crucially, where's that cash going?
Management was very clear, directing this entire sum towards debt reduction, paying down the debt load.
Okay, so what does that $2.2 billion debt paydown actually mean for an investor looking at this company?
It means flexibility, it means breathing room, and potentially future earnings power. By paying down that much debt, they've bought themselves significant time.
How so?
Well, they now have no significant debt maturities coming due until 2027. That takes a lot of pressure off.
And the bottom line impact.
If you just look at it purely from a profit and loss perspective, let's be conservative and say they save maybe 6% in annual interest expense on that $2.2 billion they paid down.
Sure.
You're potentially talking about, what, $130 million, maybe more, annually dropping straight to the bottom line. That's a structural improvement, not just a one-off. That really underpins the bull case here.
That structural change, the deleveraging, is one part. What about the internal cost cutting, that Goodyear Forward plan they keep mentioning? How's that going?
It seems to be highly visible now. The program delivered $185 million in benefits just in Q3 alone.
$185 million in one quarter.
Yep. And management confirmed they are squarely on track to hit that annualized run rate benefit of $1.5 billion by the end of 2025.
Wow, $1.5 billion annualized. That's a serious self-help engine.
It really is. It gives them a buffer, allows them to weather some of these external storms, regardless of what happens with overall tire volume.
Okay, this is where it gets really interesting for me. On the margin side, premiumization. They talk a lot about shifting to higher value products. Is that actually showing up? Can we see that shift happening?
Absolutely. You can see the strategy playing out through a couple of key metrics they highlighted.
Like what?
First, they launched nearly 1,000 new premium SKU stock keeping units just year to date.
1,000 new premium products.
Yeah, and they're focusing specifically on those high value 18-inch and larger rim sizes. That segment, it carries significantly higher margins than the smaller, more commodity tires.
And that focus on premium must be helping them with the car manufacturers too, right? The original equipment or OE business.
It certainly seems to be feeding right into it. OE often means, stickier business, higher margins down the road when those tires need replacing.
So are they gaining share there?
They are. They achieved their 7th consecutive quarter of consumer OE share gains, both in the Americas and in the EMEA region.
7th quarter straight. And EMEA is?
All right, good clarification for the listener. EMEA stands for Europe, Middle East, and Africa. And notably, OE volume growth in EMEA was huge in Q3, hit 20%.
20% growth in OE volume there. Wow.
And it's being driven, they say, by this premiumization push. The OEMs, the car makers, they increasingly prefer these higher quality, higher technology tires for their new vehicles.
Okay, so lots of positive internal momentum deleveraging, cost cuts, premium shift. But we do have to turn our attention to those persistent headwinds they're facing outside the company gates. The macro environment.
Yeah, you can't ignore it. The overall industry environment remains, challenging.
How did that show up in volume?
Total tire unit volume for the quarter was 40.0 million units. That reflects a year-over-year decline of 5.9%.
Oh, 6% down. Ouch.
And that contraction really reflects a continued softness in the replacement market, both across the U.S. and Europe. That's their bread and butter, so it hurts.
And that softness, it seems like it's rooted in these sticky channel inventories, right? Like dealers are still stuffed with tires from before.
That seems to be a big part of it, yes.
Right.
Particularly in the U.S. consumer replacement side. Remember all those tariff talks earlier?
Vaguely, yeah.
Well, it caused dealers to pre-buy a massive glut of lower-cost imported tires ahead of potential tariff implementations. Think of it like a store manager stuffing their back room because they heard prices might jump.
So even though maybe fewer cheap imports are coming in now?
Exactly. The rate of those low-end imports did slow down in Q3, but the inventory already in the channel, it remains sticky. It's sitting there. And that pressures their ability to sell their own, generally higher-priced, replacement tires into that channel.
And is it a similar story in Europe? Issues with imports?
Similar but slightly different dynamics. In Europe, they're facing that replacement softness amid both the anticipation and the actual influx of what they call non-ETRMA imports.
Naughty.
Yeah, it just refers to tires coming from manufacturers outside the main European Tire and Rubber Manufacturers Association regulated zone. So essentially, you've got cheaper, potentially less regulated imports flooding the market, adding serious competitive pressure there too.
Okay, and speaking of tariffs, the uncertainty around the proposed EU tariffs is also playing a role now, isn't it? Not just existing ones, but what might happen.
Absolutely critical point. The EU is currently considering potentially highly punitive countervailing duties. The proposed rates range wildly from maybe 41% all the way up to 104%.
104%.
Yeah, and Crucially, there's the terrifying possibility that these could be applied retroactively.
Oh, wow. That creates huge uncertainty.
Exactly. It makes channel partners, dealers and distributors incredibly nervous. And it artificially dampens current sales because no one wants to get caught holding inventory that suddenly gets hit with a massive retroactive tariff.
So what's the current cost impact of tariffs they're already dealing with?
The company's annualized tariff cost exposure currently sits around $300 million. They did get a small bit of good news recently, though. That figure was actually reduced by about $50 million thanks to Canada eliminating its tariffs on U.S. tire imports, effective back on September 1st. So a small win, but the bigger EU uncertainty looms large.
Okay, let's pivot then to the forward guidance. Look ahead to Q4. Because sequential momentum, quarter-over-quarter improvement, that's clearly the narrative management wants investors focused on right now.
Totally. They are guiding for a, quote, meaningful sequential increase in Q4 SOI, driven primarily by the usual seasonal uplift you get towards year-end, plus their ongoing pricing execution.
Did they break down the drivers for that Q4 improvement?
They did. Walk through the numbers pretty clearly. For Q4, they expect the price mix benefit to be robust, guided at a positive $135 million just for the quarter.
Okay, strong pricing. And the Goodyear Forward plan.
Still chugging along. Expected to deliver another massive benefit in Q4, around $180 million. So that self-help story, it really continues.
But there must be headwinds, too, for Q4. What's offsetting some of that?
The primary headwind investors really need to factor in is about $70 million in what they call unabsorbed fixed costs.
Unabsorbed fixed costs, meaning because they're cutting production?
Exactly. This is directly tied to lower production levels. They're deliberately reducing factory output to help drain some of that sticky channel inventory we talked about.
How much are they cutting production?
Production volume is expected to be down significantly year over year in Q4, maybe by as much as 4 million units.
Wow. So it's a necessary evil, basically. Cut production now, take the cost hit to fix the inventory problem for later.
That seems to be the trade-off. Reduce output now, normalize inventory, but you pay for it with that $70 million hit from underutilized factories in the short term.
Makes sense. They also spent quite a bit of time talking about cash flow, didn't they? Especially given that big deleveraging push.
Yeah, cash is king right now for them. While free cash flow was actually a use of cash in Q3, negative $181 million, they expressed strong confidence about Q4.
What are they expecting for Q4 cash flow?
They expect to generate, quote, strong free cash flow in Q4. They said it's consistent with historical seasonality. Q4 is usually a strong cash generation quarter for them. And given that $2.2 billion deleveraging mandate, you can bet cash generation is the absolute top priority internally.
Okay, let's look even further out then. Critical investor context for 2026. Now, formal guidance isn't coming until the February call, but they did give some key early drivers to think about for modeling purposes.
They did, which was helpful. They provided some crucial visibility on that longer-term balancing act. On the positive side, the tailwinds.
What are the big tailwinds for 26?
Well, first, they project carryover benefits from that Goodyear Forward plan, the cost savings of at least $250 million rolling into 2026.
Okay, $250 million more savings baked in.
And potentially even more compelling is the raw material outlook. At current spot rates for key commodities, they're forecasting a raw material tailwind, meaning lower costs of about $200 million for 2026.
A $200 million cost benefit from raws. Nice. Does that account for the fact they sold their chemicals business?
Good question. Yes, they specifically noted that this $200 million tailwind forecast already factors in the anticipated increase in costs from having to source some chemicals externally now from third parties. So it's a net benefit figure.
Okay, so lower raw material prices plus another $250 million in cost savings rolling over. That sounds like a pretty serious tailwind building for 2026.
It definitely could be.
But of course, there will be headwinds too. What do we need to factor in on the negative side for our 2026 thinking?
Right, the usual suspects. First, general inflation. They're modeling that at around $200 million to $225 million, which seems pretty consistent with historical cost pressures across the board.
Okay. Inflation eats some of it back. What else? Tariffs.
Tariffs? Yes.
Yeah.
The carryover impact is expected to persist, at least through the first half of the year under the current structures. They modeled that headwind in the range of $150 million to $160 million for the full year 2026.
Okay, $160 million drag from tariffs.
Weighted towards the first half, yeah.
And then finally, they walk through the sort of complex puts and takes from integrating the full impact of selling those businesses, right? The divestitures.
That's probably the trickiest part to model accurately. The sales of the Dunlop brand rights and the chemicals business, they will create annualized earnings headwinds because, well, that profit is gone now.
How much of a headwind?
We're talking roughly $65 million lost related to Dunlop, and then a combined $60 million hit from the lost chemicals earnings, plus some leftover stranded overhead costs associated with that business.
So about $125 million earnings headwind from the sales.
But ET, and this is key, that's largely offset from cash flow perspective at least, by a $60 million amortization benefit related to how the proceeds from the asset sales flow through their operating cash flow statement.
Ah, okay. So the net effect is really just a smaller, structurally leaner company.
That's the idea. Hopefully a smaller but more profitable operational footprint going forward once all these moving parts settle down.
Right. Okay, time for our segment aimed at experienced investors. This is not financial advice. This is where we pitch a potentially outrageous, but hopefully plausible, trade idea based strictly on the data we've just chewed through.
All right, let's hear the thesis. What's the core idea?
The core thesis here is pretty straightforward. We think this company is still fundamentally valued by the market as basically a cyclical volume play, meaning the stock only really moves when the whole tire industry demand picks up.
Okay, that's the perception.
But the Q3 data, everything we've just discussed, seems to confirm it's rapidly transforming into more of a self-help and deleveraging story. The internal actions are becoming the main driver.
So you're saying bet against the market waiting for that volume recovery. Bet on the internal execution instead.
Essentially, yes. We bet against the prevailing sentiment that's just sitting around waiting for demand to magically reappear.
Okay, interesting contrarian angle. So what's the tactical play? How does an investor who buys into that self-help narrative actually trade it?
Given the time frame needed for these benefits to fully compound, we're looking at long-dated call options, commonly known as LEPs.
LEPs, so options expiring way out in the future.
Exactly. For listeners maybe unfamiliar, LEPs are just options with expiration dates typically more than a year out. In this case, we'd be targeting expirations maybe towards the end of 2026.
Gotcha. And the logic isn't about the next quarter's cash flow.
No, this trade is definitely not a bet on immediate Q4 free cash flow hitting some specific number. This is a highly leveraged bet on the compounding effect over the next 2 years.
Compounding effect of what exactly?
Of that $2.2 billion in debt reduction slashing interest costs, combined with that full $1.5 billion Goodyear Forward annualized run rate benefit really hitting the bottom line.
So you're arguing that if they hit those cost discipline targets, and if that potential $200 million raw material tailwind actually materializes in 2026,
right,
then the combination of reduced interest expense, remember that $130 million-ish we ballparked earlier, coupled with the margin expansion potential from those premium OV gains, that could lead to really unexpected earnings power down the line.
Precisely. It's fundamentally a misalignment bet. We believe the current stock price might be disconnected from its future, leaner, more profitable operating profile. The market, we argue, is underappreciating the impact of the leverage reduction and the scale of the cost-out program.
So the eventual volume recovery, whenever it actually happens,
becomes pure accelerant, pure upside gravy, rather than the necessary catalyst the market seems to be waiting for to re-rate the stock. That's the thesis.
Okay, summing it all up then, this deep dive really showed a company successfully executing on its portfolio cleanup, getting disciplined on costs, really controlling the controllables, as they say.
Yeah, and using that internal execution to offset these persistent industry-wide headaches around volume and import pressures.
The narrative definitely feels like it's shifted from just waiting for macro demand to recover to focusing internally on self-help, deleveraging, and that premiumization strategy.
So we'll leave you, the listener, with this provocative thought to chew on. The biggest remaining wildcard seems to be the timing, and maybe more importantly, the ultimate impact of that pending EU tariff decision.
Right. If those final rates come in really high, maybe even retroactive, will the structural transition and the self-help benefits we've discussed be swift enough, powerful enough to outweigh what management hinted could be a significant Q1 2026 channel inventory digestion period in Europe?
That digestion phase feels inevitable if tariffs hit hard. Can the internal improvements overcome that near-term pain? That's the big question for early next year.
Definitely the key variable for the start of 2026. Something certainly worth mulling over as you finalize your own models and thinking.
Absolutely. Well, thank you for joining us on this deep dive.
As always, we encourage you to take these data points, analyze them yourselves, and form your own conclusions.
We will be back soon with more critical analysis.